Ladies and gentlemen, welcome once more to the FT headquarters and our annual roundtable discussion on the developing role of exchange-traded funds in private client portfolios. I'm delighted to see such an august panel of speakers in front of me, and I'm hoping I can provide you with questions worthy of your undoubted talents. Our aim today is to look at the proliferation of ETFs in the wealth management industry, to examine the regulatory challenges confronting their use, to analyse the changing business models in wealth management which their inclusion has inspired, to determine how they can best be differentiated by private banks, and to hopefully achieve some level of consensus on their future use. Before we start the debate, please can we go round the table and introduce ourselves, if we start with Eleanor.
Eleanor Hopewell, Head of UK Distribution at Spider ETFs.
Alan Miller, CIO, SGPB Private, Manager of Discretionary Portfolios.
Alan Higgins, CIO of Coutts.
Eric Verleyen, Chief Investment Officer for SGPB Hambros.
Philippides from Amundi Asset Management. I'm Head of ETF and Index Sales for UK and Ireland. We manage approximately 12 billion euros in ETF assets and $1 trillion globally.
Lance Peltz, Executive Director, Julius Baer, part of the Fund Solutions Group, responsible for due diligence in a number of areas, including ETFs.
My name is Marc de Kloe. I'm from ABN Amro Private Banking, based in Amsterdam. ABN Amro has about 170 billion euros in assets under management. I'm responsible for the funds and alternatives business there, so the whole product range ranging from ETFs all the way through to hedge funds.
If I start with Eleanor Hopewell of State Street Global Advisors. Eleanor, if we look at the factors that are driving the expansion and proliferation of ETF product ranges, is it really customer demand, or is it innovation in groups such as yours which are the key factors fueling this expansion?
It's a good question. I would absolutely say it's probably a combination of both, and the dialogue that we certainly have with the different users, whether they're existing users or new entrants into the market, has been what has created and fueled a lot of the new growth, particularly here in Europe, which faces different challenges than the US in terms of the US ETF market.
Afraid to say, I think most of it now is producer-led. People are looking to differentiate and create new niches and exploit new niches, and I think the use of those is limited and it's somewhat transitory.
Philippides, do you agree with this summary from your colleague from Julius Baer, that it's very much producer-led ranges being launched rather than the demand from the clients?
Certainly there's, what you see in ETF space is a lot of innovation. And that is, I think, a conversation between investors and the changing way that people are actually investing. So you had the plain vanilla kind of ETFs that everybody's is using, but now you've actually just seen more thematic products. You've seen the access to the asset classes, and now you're seeing for what's labeled a smart beta, although I'm sure the industry can think of maybe a better name for it, over time. But these strategies are making themselves their way into portfolios, and as Alan mentioned before, there's a changing environment, to how people are using the ETF. So people are using or trying to get factors into their portfolios as opposed to just single securities. For example, tilting or equally weighting, or doing other, other type of using other types of tools. Historically, maybe a portfolio manager could have used a custom basket to get a theme for luxury or for something else. The ETF will give them something which is liquid, traded on exchange, and they can minimize counterparty risk, etc. So it can become a useful tool, and this and the producers are also responding to these market conditions and trends, trying to find the innovation. Not everything works in terms of how products are launched, But I think what you're seeing through the ETF, the ETF avenue, is a lot of innovation and enablement in the investment process.
If I can bring in Alan Miller here of SCM, what for you have been the key regulatory challenges facing the wealth management industry, and how have these contributed to the growth of ETFs?
I mean, a lot of people said, I suppose, a year or two ago that RDR would transform it, but RDR hasn't transformed it at all, in my view. I mean, what it's shown is actually there's been incredibly expensive unbundling, and the sum of the unbundled layers is actually now more than the bundled layer was before. And the thought that, if you like, in the UK, that the ETFs would be picked up more by advisors hasn't really been picked up hugely by advisors. The pension fund consultants, I think they basically don't have a clue about the real costs of ETFs compared to index funds. They're not looking at, if you like, the underlying cost of actually buying and selling it, which is displayed on the screen, against what's not revealed in the price they're buying the units or the hidden trading costs. So actually, it's evolved and it's continuing to grow, but nothing like the rate that people probably would have expected a couple of years ago. But in terms of regulation, it hasn't been picked up by the FT yet. The biggest change is actually in something called MiFID II. And this is something which the sort of the trade bodies are trying to deny, because they can see how it basically transforms things to a different level to anything of RDR. Because there's a small amount of text in a 464-page document which says that all firms, all investment firms, and virtually every investment firm is covered by MiFID II, will have to reveal all the costs from beginning to end, so it's all the different layers added together, including transaction costs, in one number aggregated. Now, this is something that nobody's ever seen before. So where you have a large number of, private wealth managers, platforms, essentially people showing kind of their charge and somebody else's charge, another charge, different bases, nobody can add it up. So for the first time, you'll be able to add it up. So that will transform things more than anything else.
If I bring in Lance at Julius Baer, if we're looking at potentially a whole change in the models, the business models of private banking and wealth management, as we see costs getting cut, most people agreeing that the private bankers are vastly overpaid, and perhaps digitalizing much of the activity, allowing greater use of commoditized products, but with a premium on advice and allocation expertise. Do you believe that ETFs will essentially thrive in such an environment at the expense of active management?
I think the post-RDR world is helping level the playing field between the selection in terms of a policy or business level between those vehicles. I think what Alan's just said about MiFID II means that if that comes to its full fruition, there will be a greater emphasis in terms of the business model on delivering a clear value added for the firm's charge, which is either a better quality of advice or better performance. Not sure how a client in the end will compare that over the long run. But I believe that the RDR, post-RDR world, which is spreading across Europe, is definitely leveling the playing field between active and ETF in terms of a business and policy decision.
I don't think that the need for advice or access to product, or whether on an advisory basis or discretionary basis, has gone away because regulation has changed. I think what regulation has changed is really the manufacturers and the distributors are the ones who are having to evolve. The end investor here, I think, is the one who's benefiting the most. And vis-a-vis the level playing field, I absolutely agree. And I would actually suggest that the traditional passive world, ETF or otherwise, hasn't had to go through the amount of change that I certainly have seen in the UK vis-a-vis the active managers. And I think, leaving regulation aside here, we have a whole new investment strategy kind of really being adopted very quickly, which is what we call advanced beta. Most of the market calls it smart. That has an implication that the market cap weighted way of investing was somehow dumb. So we've actually said it's evolving and it's more advanced. But so from my perspective, there's more than just regulation going on, which I think is ultimately the beneficiary of the retail investor here. But it's actually the active managers that are having to adopt and change the most, as opposed to the ETF industry or the passive industry. But there's this other element creeping into it, which will also challenge active management in another way, and from an investment perspective, as opposed to regulatory and distribution and manufacturing.